Hello, my name is Marie Conser. I am a real estate broker here in the state of Oregon, and my guest today is Wendy St Clair with Priority Home Lending. Hi, Wendy.
Hi.
So tell us a little bit about you, and then we'll talk about today's topic.
Okay, I'm with Priority Lending, and we're a subsidiary of Cornerstone Bank, and we're also in partnership with John O. Scott Real Estate. And being able to have both, being a bank and a mortgage banker, we're able to have not only our bank products, which we can portfolio, but we also have investor products that we can use. So it gives us a big variety. I'm licensed in Oregon and Washington, and our company is in multi-state, so we are nationwide.
Wonderful. Thank you. So today we're actually going to talk about one of the products that Priority Home Lending is offering. It's called Equity Access, and the idea is to help people who wish to sell their home and buy another home, a replacement home, to actually make that transition by buying first and selling second. So take it away.
Yes, it's really a great program. And the fact that we're able to hold it in our own portfolio and do it in a quick, easy way, I think it's just really opening up the market to sellers that are trying to find a home first and then sell later. This opens up some of the equity for them. So this is a little bit different than what you might have heard about a bridge loan. So this functions a little differently. So ours is called the Equity Access, which I'm going to share a little bit of those slides with you. And this we do in conjunction with our Certified Home Ready program. So what we're doing is we're preparing the buyer and the seller to be able to be prepared for the new home purchase with a full underwriting approval on the equity line and on the new purchase. So that way, when they go in to make an offer, they're already underwriting approved. They already have their money lined up for their down payment, and then they can move forward and have an offer very similar to a cash offer, because everything's ready to go.
So when you're saying we're preparing the seller and the buyer, it's actually the same person.
Yes.
You're preparing the buyer who is also selling their home in order to be able to buy.
Right.
Clarifying.
Right. So the one advantage to doing the program that we have in-house that we're offering is if a seller were to go right now to just go out and look for an equity line, they're going to run into a couple of hurdles. Most lenders don't want to issue an equity line on a property that's going to be sold, and you can't have it listed for sale, and you may wait up to 2 months to get that equity line in place. We don't have any of those issues with this program. So what we ask is for the seller to come in advance and apply for the loan so we can have them all pre-approved. It usually takes about 2 weeks. And so we'll pre-approve on an estimated price on the new house, and then we'll base the other loan on the old house. So if you look at the slide that I have here, it kind of summarizes how we determine how much equity that we might be able to loan them to use for down payment. So this product is a minimum loan amount of $100,000. and it's a maximum of $300,000. So basically what we're going to do is we're going to base it on the value of their current home, and how that value is going to be established is the realtor, just like yourself, will create the market analysis, and that will be approved by the principal broker, and that's what we'll use for appraisal. So we don't require an appraisal either. So that saves a little bit of money there. And then we'll figure 75% of that, and then we'll minus what they currently owe. So we'll just leave that loan in place. And then the difference, if it's a minimum of $100,000, we'll loan them that for their down payment. So that way they can have access between $100,000 and $300,000 to start with their down payment on the new house. So they're not having to worry about selling the old home. So this loan is set up as a short-term loan. So what it does is it gives them 4 months. So after closing, they can move out, prepare their house, and get it sold. With this market, you know, they're just going so fast, we're not going to probably even see that. But the minimum payment on it is just interest only. And then there will be a 1% loan fee on that amount of money. Now on the new house, they're able to select any loan product that we normally have on our regular loans. No extra fees, no extra prices. They can do 0 points, you know, buy down, whatever they choose. So it gives them a lot more flexibility than, say, a bridge loan. And the advantage to this too is the loan fee is only based on the equity advance. How the equity advance is going to work is that we'll fund it the day before we fund the new loan. So that way they're not already drawing out an equity line and having to pay interest on money they're not even using yet. So that's another advantage to it. The other advantage is having it not cross-collateralized like a bridge loan might be, because bridge loans usually have a 1% loan fee and they're figured on the total of the two houses. So it can be thousands of more dollars. So this is a cheaper way to go. And then the other thing is when they're finished, if they still have equity when they've sold their home down the road, they can apply that to the loan we still have outstanding on the new house and reduce that payment even further if they choose to, or they can keep their proceeds. So it gives you some flexibility there. So now when we're going to qualify you, we're going to qualify them on the existing house payment because we're going to leave that in place until they sell the house, and then the new house payment, and then the interest only payment on the equity line. So it won't work for everybody, but quite a few people have fairly low payments because their houses have grown so much in equity that it's working out pretty well. So when you sell your house, that will be paid off. So the only thing you'll be left with is your new mortgage on your new house. So that kind of gives you an example of how that works in the qualifying. Now on this particular program, we do require a minimum credit score of 720. So on the first mortgages, we have a lot more flexibility, but on the equity line, we do require the 720 minimum score on that. So that's kind of how that works. And again, here's an example that shows you how you would calculate that. You would take your home value, say this one was 600,000, 75% of that, and then you would minus what was owing on your current mortgage. And that shows you what's left to use for down payment on this loan. So that can give you a pretty good size down payment. Because the big thing is right now, we're trying to put you in the most solid position when you go in to make an offer, because we don't really want to have to deal with contingent offers when the market is so competitive. You want to have the strongest offer that you can. So when we're talking about the certified mortgage ready, what that is basically on both loans, we'll have already underwritten you, pre-approved you through underwriting, not just pre-approval, it's an actual conditional commitment. So a lot of realtors will ask for that sometimes when they've had problems in the past with the mortgage falling apart or something, but it's really one step better than a pre-approval because it's a full underwriting approval. So when you go in and you're competing, you take a look at this, you can see the difference between a pre-approval, what we've done. We've looked at your credit and your assets and income, but we haven't gone through a full processing and ordered verifications of employment and things like that we normally do on a loan that's under contract. So we're going to treat it just like you've already found a house, you're going to already be approved. So when you compare that to a cash sale, you're not waiting to get an equity line or something else. The money is already all lined up, and we can let the listing agent that you're trying to offer through, let them know that you're totally approved already and we're ready to go. So that's an advantage, I think, there too, is that you've got both products approved on both things in advance. So when you go out to look and make offers, you're ready to go. The other thing I really like about the equity advance over a bridge loan, for instance, is that on the new mortgage that you're picking for your house you're going to buy, you can use any product that you want. And if you're on a bridge loan, you're usually stuck on one particular product. So this is another way to get flexibility. So that's pretty much the gamut of how it works.
So that's great, because from a real estate standpoint, when we go out to write offers and we are competing against other offers, we can be at a disadvantage if we have to sell a home and make this contingency, build this contingency into the offer. This program allows them to access that equity and make that cash basically down payment without creating this contingency, which is helpful when you're competing.
Absolutely.
In addition, what I heard you say is that this equity access will be a line of credit on the home they're selling, so it will be reimbursed as part of closing that sale. However, what I heard you say as well is that if there's actually more equity in the home, they will have the option to either keep that equity if they wish, or apply it towards the mortgage on the new home by recasting the loan Did I hear that right?
So recasting, so we want to make sure people understand, is recasting doesn't require refinancing. What we'll do is, so they're going to probably have extra equity since we're only giving them 75%. And of course you figure your expenses, but that extra amount, you can apply it onto our loan for the new house. And we just recalculate your payment for you and give you the lower payment. So if you don't want to just have it pay the loan off early, you really want to get that lower payment as if you'd sold your home, we'll do that for you without refinancing the loan. So you'll have the same loan, just the lower payment, lower balance, because you've applied the extra.
Yes, and all the terms will be the same. Is there a fee for recasting?
Yes, we do charge a $295 fee at the time of recast.
Oh, well, that's
Yeah.
not expensive if you're going to actually save money monthly by applying that additional equity towards the new loan. That can actually be I mean, you can break even pretty quickly potentially.
Yeah, and it's a lot less than a refinance that, could be $4,000 or
Correct.
$5,000. So it's a lot less. And that's the other advantage, to be able to hold our own loans and portfolio them on this product, because we don't have an issue with recasting.
Right. Well, that sounds like a great product. I know it's fairly new. I mean, it's newer in our arsenal of tools that we have to help people sell and buy their homes. So thank you so much for taking the time to explain it to us today. Would you like to add one more thing before we close this conversation?
I just think it's really good if you're not sure which route to go, because we've got 2 or 3 different ways that you can access equity or recast or bridge. It's always good to consult with your realtor and consult with your loan officer so we can maybe help you work through those questions.
Absolutely. So contact us if you have additional questions or if you want to know if it's a good fit for you and your project. I'm available at the number below. Wendy is available at the number below as well. Thank you so much, Wendy. Have a great rest of your week.
You too. Thanks for having me.
Thank you.